Welcome to the EACC's EU Economic Update. Hold on. We will be talking about the summer update for the European economy and how that economic development affects the relationship with the United States. And the event is organized by the European American Chamber of Commerce, New York, in collaboration with the European Commission. And my name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC, and I will be moderating today's discussion. My conversation partners include Ben Carlina. He's a senior economist at the EU delegation to the US based in Washington. And we have an old friend joining us, Sander Tordois, senior economist at the Center for European Reform based in Amsterdam.
Berlin.
Berlin. Close enough. Even better. Oh. And let's dive right into the conversation. Ben, the economic data that you've been looking at for the last 2 months sets what's going on in the economy against a couple of potential risks. Some of them risks and opportunities, I should say. Risks, what's still going on in Ukraine, high energy prices, but also the developments with the green transition and with the digital transitions. What are you seeing?
Well, first of all, just thanks for having me back. It's great to be here. And maybe I could just sort of set the scene a little bit in terms of the current economic situation that we've had, and then we'll take it from there. I would maybe like to start by noting that a year ago, when we were chatting here around this time a year ago, many economists expected there was going to be a recession coming in both the US and Europe in 2023, right? We had this big energy price shock from the war in Ukraine, and we had the onset of this rapid tightening of monetary policy that was coming in response to high inflation. And these factors were expected to weigh heavily on growth. But in fact, this recession never happened. Instead, growth has continued, and in spite of higher interest rates, and inflation has fallen slowly but steadily. And so where are we now? What's happened over the course of the past couple of months? Well, inflation has fallen further over the course of the summer. In the Euro area, HICP inflation is now 5.3%, both headline and core. And in the US, PCE inflation, which is the Fed's preferred measure, headline has fallen to 3.3% and core is 4.2%. And I will say that if you measure US inflation using the European HICP standard, inflation's back to about 2%. Headline would be even below in the US. So inflation has fallen a bit further in the US. And on this side of the Atlantic, that has raised hopes that the US economy is undergoing this sort of immaculate disinflation that will see pricing pressures ease without a recession actually occurring. And I think one of the big reasons that people are feeling hopeful is because of the labor market. Employment in the US is still growing, but it's growing at a slightly slower pace that hopefully will allow the labor market to continue rebalancing. The 3-month moving average of job gains is now around 150,000, and that's down from over 300 at the beginning of the year. So, and along with that, job openings have fallen a little bit. So the excess demand for labor is cooling off on one hand, and on the other hand, supply is actually increasing. You might have seen that the unemployment rate rose a little bit from a historic low. It's now at 3.8%, but it actually rose for good reason, which was that more people were entering the labor market. So, as people are coming off the sidelines, you have this tightness in the labor market is easing, and you're getting a rebalancing on both the supply and the demand side, and that is a really good thing. And it also means that with more people at work and falling inflation, that boosts real wage gains. So households are going to have more to spend. And even though we haven't seen the full effects of tighter monetary policy yet, and higher for longer rates probably will slow growth next year. If households keep spending, that means that a soft landing may actually be within reach. Now, in Europe, I should say that there's not quite as much optimism as in the United States. The strong post-pandemic recovery that we saw is now fading a bit. Even though we didn't have a recession in Europe and growth held up better than expected following the war, momentum has been slowing a bit. In the second quarter, GDP grew at an annual rate of 1% in the euro area as compared to 2.1 in the US. And on top of that, we've had a bunch of survey data that has weakened notably. We've got the Purchasing Managers Index, the PMIs have come in pretty weak, and economic sentiment in Europe has also weakened a bit. But again, I would say that the issues in Europe are pretty concentrated in the manufacturing sector. The manufacturing sector has been having a tough time, still dealing with the fallout from this energy price shock. There's also pretty weak foreign demand. China's reopening has not proven to be as strong as people were hoping. And there's also, rising global competition, especially from China. And of course, the ECB's higher interest rates have also tightened financial conditions, and that's playing a role. So in the second quarter, even though for the euro area as a whole, we had positive growth, it's kind of a mixed bag when you look at specific countries. So you actually saw growth contract in Italy and the Netherlands and Austria. Germany was flat, didn't manage any growth. But other countries, and particularly the service sector, is doing much better. Tech, tourism, pharmaceuticals, those are all doing really well. And for example, the French and the Spanish and the Irish, they all managed to have positive growth in the second quarter. Another thing that is worth mentioning is that there's also a really strong labor market in Europe. Similarly to the US, Euro area unemployment is at a historic low. It's about 6.4% right now. And inflation is also falling, not quite as fast as in the US, but the fact that inflation is falling means that households in Europe also are expected to see real wage gains, and that should help support household spending over the rest of the year and into next year. Now, I think this key variable looking ahead is probably inflation, right? On both sides of the Atlantic, we're either at or very near the peak of the hiking cycle by central banks. And so I think the real question is going to be, how long are central banks going to be forced to keep rates high? If inflation continues to fall, they're going to be able to forego any further rate hikes and maybe sometime next year start thinking about rate cuts. And I think that this question is especially important because there's such a clear need for new investments, right? We needed green energy, infrastructure, technology, defense spending. Obviously, there's some structural factors at play, but all else equal, cheaper capital means businesses can invest more. So that's sort of where we are right now, and I'll stop there.
Yeah, and we will be drilling into some of the issues that you raised a little bit further throughout the conversation. Sander, what are you seeing? And maybe and maybe you can dive into some of the issues that Ben just raised, and start with an overall impression that you have, and then we want to address investment. Where is it coming from? Manufacturing sector, and also we leave the labor market for a separate set.
No, thanks. It's great to be here again with all of you in a different capacity. I work for a think tank now. I basically think Ben sketched the big picture really well. How I would summarize it looking forward is that the US, if you look, let's say, at indicators that are forward looking, the US has perhaps more upside risk on the growth front and a little bit more downside risk on the inflation front. Whereas in the Eurozone, the picture is a bit the other way around. So I would say, I think the cautiously optimistic story from Ben holds, and certainly for the US side, I would very much subscribe to it. For the Eurozone, it's definitely more of a mixed bag. And these forward-looking PMI indicators are really quite concerning. Now, the weird thing in this sort of topsy-turvy post-pandemic economy is that these PMIs have been detached from real indicators. So their predictive value for how growth, consumption, investment, et cetera, really comes in has declined. And we don't know if that relationship has broken permanently or this is a temporary feature. And I think to some extent that's the challenge for the European Central Bank, which has to make another rate decision next week and a monetary policy decision, is how to think that through, right? So if you see these relationship breakdown, how do you look forward? So I would add that in that sense, the picture is a little bit different on both sides of the Atlantic. Now, the big hope is that wages are more backward looking to an extent in the Eurozone than they are in the US. And that's because labor unions are stronger, there's more collective wage bargaining, there are also more built-in wage indexations. And to some extent, real wages in the Eurozone are compressed, right? There's been a massive energy price shock, much bigger than the US. The effects of the war next door are much larger simply because of proximity and exposure. And so real wages have actually declined. And to some extent, you see now fairly high nominal wage increases in Germany and basically in most countries in Europe. And that's to some extent catching up, right? They're simply catching up with lost ground. But if inflation continues to decline, maybe not as fast as in the US, but if it continues its downward path, at some point, these nominal wage increases reflecting last year's inflation in the European sense, because they're a bit backward looking, may actually be higher than inflation next year. And that's when you have this sort of positive scenario from the European consumer side where they see real wage growth and that may underpin strong consumption.
Yeah.
The concern is a bit that, the shocks in the manufacturing sector, Chinese competition really ramping up, and Europe is much more of an export-oriented economy than the US, that may spoil the broth. And I think particularly for Germany, there are a lot of structural problems in the economy, and they're really starting to surface. So if you look at, for example, where the economy is today versus 2019, Germany has barely grown. It's more or less flat. I mean, it's been a lot of ups and downs, but basically we've had 4 years of flat development. Other countries in Europe are doing exceptionally well. Even the Netherlands is now having a rough patch, but it's more than 6% above pre-pandemic levels. So it's very much a mixed picture. And you see some of these big geopolitical factors also featuring in those growth outcomes.
Yeah, it's definitely Germany being the largest or one of the larger economies in Europe is driving the averages down. And it's just like, it seems to me, being German, that there's kind of like a general malaise that may not be warranted necessarily, but seems to be like a dark cloud hanging there that, is kind of holding things back. Let's talk a little bit more, dive a little bit more into the policy measures. So lots of policy measures coming out of the EU, and Ben, I would like you to start with that. How are they showing up in the real economy? We have the Green Deal, we have various policies on digitalization, we have the industrial strategy that Breton's team is working on. Are they showing up? Are they having effect?
Sure. I mean, the first thing I guess to say is that the EU has been able to quickly adapt a couple of the major programs that they rolled out during the pandemic and use them to deal with, the shock of the war and the need to, totally redo the energy infrastructure in Europe and also deal with some of these emerging challenges like, geopolitical competition and like climate change and all that stuff. So the recovery and resilience facility which was introduced during the pandemic. It's a big pot of money. It's 723 billion euros, split between grants and loans, and that money is being rolled out, and there's still a bunch of money left. It hasn't all been allocated. One of the things that has, I don't want to say delayed, but that has, the adaptation has occurred, is that after the war, they were like, oh, we need to have this Repower EU initiative to, make sure that electricity transmission can work more easily between countries and get where it needs to go, and build natural gas LNG platforms, off the coast. And so a lot of the countries in their, RRP plans, the recovery and resilience plans that they had to submit to the Commission to get this money, have been redoing them in order to deal with some of these new challenges that are occurring. But I think that they are being very supportive, and particularly in some specific countries, because the money is not being distributed 100% evenly across Europe. It's a huge deal for countries like Italy, where the amount of money that they're ultimately going to get is going to be around 10% of GDP. So it's going to have a huge impact. But I think the key thing is whether these policy initiatives can boost the competitiveness of the European economy. And I think, that remains to be seen, but hopefully it'll be successful. I don't know if Sandra want to add to that.
Yeah, we're going to dive into the competitiveness in a minute. I would like to stay for a minute on the manufacturing investment. Because Dave, what I've seen, just talking to our members, there's a lot going on in that space in Europe, and related to the digital transition and other initiatives from early on. But there's also, that I want to talk a little bit about the IRA and what's happening in Europe, what's happening in the US in that manufacturing space. Who wants to start with that? Sandra, do you want to start about the IRA? You've recently done a report on this and analyzed, how it will affect European companies and their expansion.
Yeah, I mean, one of the big stories in the transatlantic space has been the sort of spat about the Inflation Reduction Act, right? The Europeans were first extremely pleased to see that the US was making a big move on addressing climate change, albeit by leaning only on subsidies, because carbon taxes are political poison in America. Whereas in Europe, they can do more of a mix, right, of instruments. But that was the initial sentiment. And then at some point, it flipped when the Europeans realized that a sort of integral part of the Inflation Reduction Act were some fairly protectionist clauses, in my political reading, mainly meant to de-risk the US from China. But the Europeans became, to some extent, collateral damage. And that led to a huge uproar in policy circles, but also led to a lot of European multinationals threatening to divest, cap in hand, seeking European subsidies. Now, my colleague and I were a bit skeptical of that narrative, because there was simply no data, right? Like, was Europe really doing that badly on electric vehicles, batteries, heat pumps, all these sort of green goods of the future? And so we built a big database of 220 low carbon technology goods as defined by the IMF, and see how those are being traded in the world as a measure of competitiveness. And the results were very surprising, or confirmed our, let's say, skepticism of the anecdote-driven policy, because essentially what you see is that Europe's market share of global exports in these 220 goods, so that includes EVs, it also includes, locomotives for electric trains, it includes building insulation materials, really, so the whole swath of products you need for the green transition. And Europe's market share has been growing. It's been growing from 19 to 23% over the last few years. China's market share is exploding. I'll come to that in a second. It went up to 34%, down, I think, from around 20%. And the US is sort of languishing behind at 13%. So more or less it's US 13%, Europe 23%, China 30%, 33%, 34%. That's the real sort of measure of global competition in that green space. And what we also saw is that basically the penalty to trading these goods across long distances is going up. And that's a well-known sort of feature of global trade that's been documented in many markets, is that as markets mature, as technologies mature, they become more widely available, things become more competitive, then transport costs really start to matter, right? Because the margins go down. And you see that very strongly, for example, in electric vehicles, in batteries. They're heavy. And so it's heavy to schlep them halfway across the world. And so the local producer that's producing in Germany for Germany or France has an innate advantage. And so that gravity effect is going up, has been going up over the last 5 years, doubling in some of these markets. And so that suggests that Europe actually is starting from a good place, probably from a stronger place than the US, and that it has a good sort of set of conditions to provide the goods that it needs for its own green transition, and maybe to some extent for the US as well. And so that, I think that's the big picture on the IRA panic. Now, does that mean that the American model of really subsidizing the big manufacturing and trying to catch up primarily with China is completely wrong? I don't necessarily think so. I think for the US, they clearly need to catch up. They're starting from a weaker condition than the Europeans, and so it makes sense to some extent to go big on that. But even for the Europeans, they should be careful doing the widespread subsidies, because it's already going well, and so they'll waste a bunch of public money and give it to companies that are having robust demand as it is, and will continue to do so because of the local effect. But I think there are some markets where you have real concern, where you see the sort of the Chinese playbook that we saw for solar panels, where they're more or less a global monopolist. So they shut off their own market, they throw a lot of subsidies in these industries, and then they start exporting once they have scale, and basically shove other producers out of the market. And so we saw, for example, in wind turbines, you see this happening kind of dramatically, actually. So the Europeans were leading the global market on wind turbines. China has overtaken the Europeans in a matter of 4 or 5 years. And European wind turbine producers are struggling. Many of them are issuing profit warnings. They're struggling with inflation, with long-term contracts and so I think in that particular area, Europe may actually need and want to subsidize wind turbines if it wants to have a domestic supply of it, right? And so there are a few markets where you see these kind of dynamics. And my message to the Europeans is always, stop fretting so much about the US. Look to China and call DC and make sure you guys get along, because you kind of have the same problem. So I'll stop there.
We get into the getting along in a minute, but what I'm hearing you say is, and what I think is based on your study, what I thought was really interesting is like that the German economy has the largest percentage of low carbon technology. So they are setting, they kind of like seem to be behind a little bit, but they seem to be well prepared, going forward. From what it looks like to me, and we won't make that study available after the program. Ben, what's your take on this? Manufacturing in Europe, replacing internal demand with increased exports. I mean, it's like a different policy for a different market. Is that all there is to it? We're doing it differently because the situation is very different across Europe.
I think it's quite possible that in the future that people are going to look back on the last couple of years as this pivotal moment in history where some things fundamentally changed and we're sort of in this new era. Now, obviously, there's a lot of uncertainty. We don't really know if there's permanent structural changes to the economy that have occurred from the pandemic and the war, but it seems like there have been. And I don't think that everything is coming from, this isn't just a story about policy, right? Like after the pandemic, businesses realized that they had to change the way that they think about supply chains and about labor supply, especially because suddenly you needed to make sure that your supply chains were resilient and you might not want to be dependent on a single factory in a single location. you want to make sure that you could retain a skilled and reliable workforce. And so there's questions like, what is going to happen as the labor market slows down? Maybe you won't see a big rise in the unemployment rate because businesses want to retain these workers because they had such a difficult job rehiring and retraining people after the pandemic. So I think that a lot of these changes are coming from the private sector and changes in how people and businesses feel about things. But of course, there's also been big changes for policymakers because on the one hand, I think during the pandemic, they saw how effective public policies can be in safeguarding public health and incomes and specific jobs. But I think people were also really shocked by Putin's invasion of Ukraine. And it led many people to question this old assumption that increasing trade and investment is necessarily going to lead to the spread of liberalism and increased international cooperation. And especially for Europe, it's underscored the need to invest more in defense. So the result of all this is that we are seeing this bigger focus on industrial policy. There are these big pots of money getting thrown around, but it also doesn't look to me like exactly these old forms of protectionism and industrial policy that we were talking about back in the 20th century. Especially if you look at the IRA, it's this mixture of, regulatory measures and tax reforms and financial incentives that, on the one hand are trying to make help companies make supply chains safer and more resilient. It's definitely a huge clean energy component, which I think we should all be pleased about because America was definitely lagging the rest of the world in starting out on this green transition. But a lot of these policies are aimed at crowding in private investment, particularly in new manufacturing capacity, which, as Sandra pointed out, the U.S. is starting from a weaker position. And so it sort of makes sense that the U.S. would want to encourage some of this stuff. We have seen in the U.S., I think the numbers are a bit, I don't know, clear, that's not the right word, but we've definitely seen this boom in investment in the manufacturing sector and manufacturing construction over the past year. It's like way up and it's sort of incredible. Now, it's hard to tell how much of this is due to the IRA and how much of this is due to companies wanting to bring their supply chains back closer to home. But these trends like friendshoring and nearshoring that people talk about, they are real and they are already beginning to have an impact. So I guess the question really is, can we manage these new types of policies in a way that avoids some of the things that we know are risks, like wasting money on uncompetitive factories and things that don't make sense, and the possibilities of corruption. And so that's sort of the open question.
Yeah. And I was just going to head there because this whole de-risking, it's not deglobalizing, it's de-risking. And I think that was more driven by the pandemic than anything else, and then re-emphasized by the war. You needed to stop doing business with dictators because you're dependent on a resource that is not freely available to you anymore once a company goes down the other side. And on that note, where are we on the friendship between Europe and the United States? We see, especially in the context of the IRA, there's a lot of drama, but is it really that dramatic? When I'm talking to my colleagues at the Commission, they're cautiously optimistic about the relationship. They love working with the Biden team. We have the Trade and Technology Council that seems to be working. Is Europe and are Europe and the United States working together? And is it working? Sandra, I'm putting you into the
to
comment on that.
I'm happy to have a first swing at that. I would agree with the sort of general picture you sketched. I think there have been some significant tensions about, for example, the fact that Inflation Reduction Act, tax credits, financial incentives more or less de facto excluded European companies. But some of that has been resolved, right? So if you look at how the Biden administration is implementing the tax credits for electric vehicles, they created essentially a loophole for the Europeans and the South Koreans, where if you lease a vehicle, so if a European company sells vehicles to a American company that then leases them, then you do qualify for IRA tax credits. And surprise, surprise, what do the data show? European companies are suddenly selling a lot of leased vehicles in EVs in the US, right? So I think that's a serious sort of victory in my view for transatlantic diplomacy, that they basically softened the blow of a piece of legislation in the US that was probably not meant to harm the Europeans as much. And besides, I think some of Europe's premier car makers anyway sell cars above a price point where IRA credits play a role. So you see that in EV markets, European exports to the US are growing, in my view, quite healthily. To China, they're flat. So it basically goes to the big point I was trying to make before. Now, the bigger question of de-risking from China, I think the Europeans are a bit behind on the US on that. For one, because they're simply behind, and they may have different interests, they may have a different intellectual framework for thinking it through. But on the other hand, I think the US has also at times been an unreliable partner for the Europeans, certainly in the Trump years. And so some degree of hedging on the part of Europe is logical, right? It doesn't seem, or maybe even rational, unless tensions escalate to the point where they're forced to choose. But until that point, I think it's a balancing act with a clear tilt towards the US from the European side. And I think that balancing act between the Biden and von der Leyen team has been done well. I think the sort of Ukraine support, the unanimity on that, the strong sanctions on Russia, all of that has helped, I think, to bring Europe and the US closer together, and probably as a sort of positive side effect has also helped to settle some of these trade and investment and technology tensions between the two blocs themselves.
Yeah, that's the sentiment that I was, or that's the impression that I'm getting as well. And it was also my story to the commission. It seems to be we have a can-do attitude. And I mean, Biden has to sell his IRA to the Americans. So the storyline that Secretary Raimondo is having is obviously focusing on how to make this as tasty to American audience as possible. And then we're been doing the same in Europe with our policy measures and making them look good in European eyes.
Yeah, I mean, it's always a question of how political processes work. And I think, that's one of the things that my colleagues here in the delegation and Brussels have been talking about with their counterparts in the Biden administration. I also have the impression that the discussions have been very constructive and are making progress, and people are hopeful that some pragmatic solutions are going to be rolled out and announced publicly at some point later this year, hopefully in the next couple of months. And I think, to get back to what you were talking about earlier, I mean, the EU is also continuing to roll out some new initiatives that are not just about the bilateral relationship between the US and Europe, but about, broader relationships with other countries as well. So when you hear about things like the critical raw materials plan, I mean, this is driven in part by the realization that lots of these rare earths, minerals, and other obscure metals and things like that are needed for everything from construction of batteries to semiconductors and all kinds of clean tech, that sort of while the West wasn't paying attention, China has gotten this dominant position of processing these materials and controls a huge proportion of the market for many of these goods that you really need to source if you have any hope of having a competitive industry that requires these inputs. So, this plan is going to be used in conjunction with signing trade agreements with a bunch of countries and the EU is currently working on that. And for things like this to work, it has to be in the interests of both sides, right? A lot of the emerging markets that or where you can find the mines for some of these materials, they would like to do some of the processing domestically and have some value added and not just be pure commodity exporters. And I think that there's going to be the scope for doing that. And the EU and the US are also going to work together on how that should work, what the rules should be. And that's one reason to be hopeful that, in spite of what is clearly geopolitical competition and efforts to de-risk, that you can still move in the direction of maintaining a rules-based order that is so critical for how Europe thinks. And I think, also to say, one of the reasons why the IRA did cause such a storm in Europe is because it threatened a little bit the way that the European single market works. And I think that, policymakers understand that everybody has their own political processes and how things work. And yes, the United States Europe was sort of collateral damage in how the US was thinking about this when they passed the Inflation Reduction Act. But one of the reasons that people were upset in Europe is because it was like, hey, this is a threat to the single market. We need to make sure that the single market continues to be a level playing field and continues to work smoothly. And so that's why it's taken a little bit of time to work out some solutions, but they're on the way.
Yeah. We have a question when our panel thinks the EU or US will be autonomous about semiconductors. And just to add to that, I would like to use that question to start our next segment, is if Europe is competitive. Let's start with that, with the answer of that question, and then dive into the competitiveness issue on the world stage.
So I have a first
one. Yeah, I'll let Sandra go first. Yeah.
I mean, I just cited our research. I think certainly on the clean tech side, the trade data speak for themselves, right? That I laid out. So I think there's no question that Europe is competitive in green tech, as long as they're not overly naive about some of China's more dodgy practices that may stymie building up scale in those areas, right? Overall competitiveness, I'll touch on in a second. I think on the semiconductor side, I mean, I'm a bit skeptical that either the US or Europe can use the sort of subsidies of the CHIPS Act to really become autonomous on semiconductors. My understanding is that these value chains are so incredibly complicated, and there are loads of firms around the world involved at each stage, that onshoring completely or nearshoring completely is extremely risky, and I'm fairly likely to fail, right? But what you can do is to probably build a bit more domestic production capacity, to be a bit less dependent on having production capacity there in case you need it. And I think there, I would say there's been one thing that's been bothering me a lot. So that there's been a sort of deal between the US and the Netherlands, my home country, for the Dutch, who have an ASML company, which is the global monopolist in producing the kind of machines you need to make cutting edge chips. And basically the Dutch agreed with the Biden administration to stop selling not only the very sort of top-notch machines, which they had already stopped selling to China in 2019, but also to stop selling the sort of generations just below that. I mean, that's fine, right? But what I thought was strange about the deal and a missed opportunity for the Europeans, if you have that kind of joker card, namely you have a European country that's the only country that can produce this stuff, literally the only country, then you have some leverage, right? And so I found it surprising that the Europeans didn't ask to have maybe, for example, a guarantee across the Atlantic, maybe also with Japan and Korea, to provide each other with semiconductors, even in times of super high global tensions, right? Because each on their own will not be able to have a independent production chain, but if you add them up, you get a lot further, right? You're still going to be dependent on Taiwan, you're still going to be dependent on other countries. And so that to me was a missed opportunity. And in part, it's because export restrictions are national competence. The Dutch were pressured by their own. Apparently the Germans, the French, the Commission, I don't know exactly what happened, but they didn't seem to have been at the table. And so you kind of don't internalize the European interest, which in my view is also the Dutch interest, right? If German car makers can't get chips and go into a big crisis, then the Dutch economy suffers as well. So I think there's more work to be done diplomatically, I think, to improve these kinds of de-risking deals in a more realistic way. I'll stop there.
Well, I think just to jump in on that, I think, a key point is that we shouldn't forget that Taiwan and Japan and South Korea are already key allies, key members of the global economy. I don't think that either the US or the EU are aiming for autonomy in semiconductors. They want to de-risk from China. And I think that that's a reasonable goal to have. And I think that working with partners across the Pacific and the Atlantic makes a lot of sense and is the key to success going forward, because Taiwan does have the most competitive semiconductor industry right now, and for good reasons. And so there's reasons to be worried about that, given the tensions between China and Taiwan. But this is an area where I think cooperation and friendshoring makes sense.
Yeah, I agree, and I think there's a lot still to be discovered in terms of technology innovation in the chips market. One of our member companies is the Israeli. They have come up with a new way of packing these chips and setting up the chip itself to decrease the heat that they produce and make them faster and less heat producing for big chip factories and programming tasks, AI analysis, etc. So there's still a lot to be said in that space. But what about other areas? Sander, you mentioned building insulation, wind turbine, solar, EV. Where does Europe shine these days in terms of competitiveness, and what's the outlook on the European manufacturing sector?
I mean, where Europe shines is a different area, I would say. It is in those areas, as I discussed, but it's also in pharmaceuticals. It's in semiconductor machinery, like I just discussed, where the Dutch are the tip of the spear, but there's a huge value chain that runs all the way into Germany and the rest of Europe, right? So this is also a product of the single market. And then there is basically luxury goods, right? So if you look at the most valuable European companies today, many of them are basically big fashion giants. And so you could say, well, it's a lot less high tech than the sort of big techs in the US, but it's a big industry and the margins are very high. It employs lots of people. I think as an economist, I'd say, well done, Europe, right? You've carved out an incredibly globally competitive niche that nobody in the world can sort of compete with at that scale. So it's a mixed bag. I think the big problem, to my mind, is more on the old industry side, right? So we know Europe is going to have higher energy costs structurally without Russian gas. It's going to take time to replace that with renewables. Renewables are amazing, but you have a problem of intermittency, right? Sometimes the sun is not out, sometimes the wind's not blowing. And so the overall cost of energy could be significantly higher as a result than if you have gas. And so that question of, is Europe still able to produce chemicals, paper, glass, steel, the sort of core basic industrial goods that are very energy intensive? I think that's an open question, and it's a very tough one. And in Berlin, where I work, this is the big fear at the moment, is that industry is either leaving or collapsing. And then the question is, I don't have any empirical research on this, but the question is, to what extent do you need these basic industries that make inputs for other industries so that you have high tech, right? Are the two related, or can you actually let that disappear and rely on allies or just a global market? I think that's a massive conundrum for Europe, and I don't see an easy solution for it. So that's one area of sort of broad concern.
But isn't it a question then of innovation? I mean, structure these factories, have them consume less energy and make them more energy efficient, save water in the production of some of these products. Because I agree with you. I mean, you can't outsource. I mean, we're trying to reshore or friendshore. So certain industries are the the ground level of where everything else builds on. So isn't it an opportunity to innovate?
No, exactly. The question of whether it is the ground level, I think, is the key one. Surely, I would certainly hope so, but I think the jury is out on that, right? Can you innovate to the point where you are competitive in these industries with the US, which has just lots more energy, or with China, which also has lots more energy and cheaper? I think that's an open question, and it's one that European policymakers will grapple with. I'm sure they'll find a solution, but for the time being, this is a major transition problem because there are simply not enough renewables yet to have the plentiful green energy there. So I think you can do a lot with efficiency. And in fact, it's quite remarkable how well industrial production in Europe held up last year, despite energy prices exploding higher, right? There was no dramatic collapse in industrial production. There was a decline, a significant one in the really energy intensive industry. So you saw an effect, but it was nowhere near the sort of catastrophic effects that were predicted. And I think that speaks to your point, Yvonne. Like, these companies forced to react, they reacted, they innovated, they changed the way they do business, and they kept rolling. And so in that sense, I'm also a cautious optimist.
Before we have 15 minutes left, and before we get to final thoughts, I want to talk a little bit about wages, wage pressure. Ben, you addressed that already earlier. Can we dive into this a little bit further? And just like what the economics are behind wages, wage pressures, both in Europe and the US. And then I don't know if we want to get into, if we have the time, because we have maybe like 5 minutes or so for that. If we have the time to talk about workforce development. There are no electricians to bring on or to conclude, I should say, the energy transition in California, because all the solar panels that need to be installed can't be set up due to lack of electricians. What's the situation in Europe?
Well, I mean, I think, there's big differences between the labor market in the US and Europe. Sander was talking about some of them earlier. I think that during the pandemic, European businesses held on to their workforce much better than in the United States. And this is why you didn't see these big boom and bust cycles in the unemployment rate in Europe like you saw in the US. And US companies have had much more difficulty rehiring since then. But also there are these differences between how unions work in Europe versus the United States. So there's a bit more concern about ongoing wage pressure in Europe than there is in the United States. And I think it's helpful to maybe frame this in the sense of how people think about monetary policy, because traditionally a lot of economists think in terms of Phillips curves, and that's one of the reasons why people were predicting a recession last year, because they thought that the inflation rate could not go down back to target unless the unemployment rate went up as well. And on the one hand, it's reason to be optimistic that inflation has come down as far as it has without an uptick in the unemployment rate, because it suggests that these price shocks, maybe calling them transient isn't exactly the right word, but they were related to these pandemic war-related shocks, and they're not permanent. They're going away on their own, and it doesn't have that much to do with monetary policy. On the other hand, we still need to think about how long are these lags from monetary policy? Because I think one of the key risks to the outlook, as I was saying at the beginning, is how long are rates going to stay high? Are we in an era where inflation and interest rates are permanently higher? Or are we going back to some sort of secular stagnation that was existing before we got into the pandemic in the first place. And I think the questions on this are still out. But clearly it's the case that if you are transitioning to, if you made a bet on having permanent supplies of cheap Russian energy, and then that bet went bad, there's definitely going to be some short-term costs, and your economy is going to have to adjust. And maybe some of these energy-intensive industries in Europe are not going to be able to survive it. I don't know, but I think the question is, what do you do to reskill, upskill your workforce, make sure that businesses that are at the leading edge of the technological frontier can hire the people they need to? And I think in that regard, I don't think Europe is in a bad place. I think people, they have good schools, they have good universities, people are getting good educations. Obviously, you can do more, but I think this is a longer term challenge, or rather, there's short term challenges and longer term challenges, and they're not the same.
Mm. Yeah, economic participation is up both in Europe and the US, correct?
Yeah, and Europe faces maybe also some more challenging demographic trends than the United States. It is aging a bit more rapidly, and especially given the relative generosity of European social welfare pension systems, there's going to put some pressure on fiscal policy in the years ahead. But I also don't want to make too much of that, because people have been talking about this for a long time. And, if you look at, for example, Japan, sometimes people talk about all these years of Japanese stagnation. And if you look at like the headline GDP numbers, that's true. But if you start digging into like the per capita numbers, Japan has not been doing that badly. And I think that just mechanically, it's one thing to have slower growth, but if you manage to increase living standards and value added, then you're ahead of the game.
Yeah, interesting. Structural composition of the EU and US economy, just like 2 sentences from both of you. What are you positive about? What are you optimistic about? And what worries you?
You want to go first, Andrew?
Let me think. What was it? Optimistic, pessimistic, and worried?
On the structural composition of both the EU and the US economies. What are the structural challenges?
The structural challenge. Well, just to reiterate that I'm pretty optimistic about Europe's green tech manufacturing. I really think it's a key source of strength. You mentioned Germany before. Mm-hmm. Today, 4.5% of German GDP are already exports in low carbon tech. I mean, that's quite a staggering number, right? It's 4.5% of their economy. So, and it's growing. So I think that shows you, and it's way above where any of the other G7 economies are. So I think Germany as the locomotive of green tech manufacturing with clearly, you see that in the data, lots of supply from Czechia, Slovakia, Denmark, all the countries around it, is a key source of strength and optimism for me, as long as the Europeans keep their eyes open on some of the sort of sub-markets where I think there's concern from sort of Chinese mercantilism. So that would be my one. The pessimistic case, I would say, structurally, is probably related to Ben's point about structural transformation. I think the Europeans need to get a little bit better at letting capital markets do their thing and letting firms scale up. Also letting maybe some of these old industries shrink, maybe even disappear, and have some faith that they do have the people and the means and the infrastructure and the intellectual prowess to build something new. But you need to make sure you don't ossify capital and labor with too much regulation and too much, let's say, clinging on to the social market economy, but forgetting about the market economy part of that. So I think that's the part that I'm worried about, and where there's a bit of pessimism. I think particularly for Germany, the debate here is really only beginning to come to terms with that. Maybe the growth model, as it worked so well in the 2010s, exporting chemicals, cars, and machinery, particularly to China, that growth engine is gone, and they may need to just do the basic stuff at home, do the reforms that this country advocated for other European countries, get those capital markets going, and have some faith that new things will emerge. And I'm pretty sure they will.
Mm.
I very much agree on that point about it would be great if Europe could do more on banking and capital markets union. Not just because of like the financial stability concerns that we used to talk about back in the day, but clearly so that companies can get better access to funding. And when there's such clear, investment needs, I think that would be a clear win. In terms of, short-term economics, I think that, the structural challenges are not the same in every country. And so it sort of depends which country you're talking about. We've sort of covered the areas that Germany's facing. I think with countries like Italy, it's obviously things like reforming the legal sector and bankruptcy regulations and stuff like that. I don't think we need to get into that level of detail, but I do want to mention, just in terms of talking about risks, I think that, politics and populist politics is a risk, particularly in the United States. In the short term, we have the risk of a federal government shutdown that could occur by the end of the month. And I'll say that I think that the upcoming U.S. election cycle is going to be very unpredictable and weird. Similar risks exist all around the globe, but I do think that the politics right now seem particularly strange. And then, more broadly, we still don't know. I'm also concerned about the long and variable lags from monetary policy. I don't think we've seen the full effect of higher interest rates yet on either side of the Atlantic. We don't know if job growth is eventually going to stall. We don't know if there's going to be any hidden financial stability risks, for example, hidden in the commercial real estate sector. Personally, I don't think that that's going to be a disaster on either side of the Atlantic. I don't think it's going to be a financial stability risk, but I do think that investors in commercial real estate are going to have to swallow some losses, particularly in the U.S., and they'll just have to work through that. So I don't know. I think those are the key things for me, and we don't know how quickly inflation will come down, and I think that's sort of the key variable that will determine what happens with monetary policy. And the sooner that we can get rates back to a more neutral level, I think the better.
Yeah. And we had that question about the commercial real estate in the beginning. I think talking more and more to executives here, especially in New York, who are saying we're going to ask everybody to come back. So I think we're still a little bit on a mini hiatus, but I think the next 2 months are going to be the come back to the office months, and with that, real estate being reoccupied. But I still think that there's some risk in the real estate market, in the commercial office market, I should say, that needs to be addressed.
I agree. I will say that commercial real estate is much bigger than just the office market, and that's one of the reasons why I'm not that worried about the financial stability side.
Yeah, I agree 100%.
It's warehouses and factories and malls and all kinds of things.
Yeah, and each one of those has their own, their own issues as well. But yeah, I agree with you 100%. But that's for another program on which we're hosting in the fall, a commercial real estate update. But any final words?
No, this was fun. Thanks for having me.
Yeah, this is great. Thanks so much.
Yeah, it was fantastic having you. And so this concludes today's webinar. Thank you again, Sander and Ben, for setting aside the time to talk to us, sharing your insights on this. And we will be doing a fall forecast do we have the dates for that? I think it's November, end of November. What was the timing for that, Ben?
That sounds right. We don't have the exact dates, but sometime in November.
Yeah, very good. I'm looking forward to that. And quick reminder, if you're a member of the EACC, we're happy to connect you with other participants. So look for Edith sending you the list. We have a couple of interesting programs coming up The planet as an asset class with our colleagues at the European investment banks, changing tides, the corporate debt market, both in the EU and the US, net zero, how do we get there? And we're working on a sustainable investment forum together with our friends at NYSE. And we will be uploading the recording onto the website in the next couple of days. And with that, again, thank you for joining us, and we look forward to see you at our next event.
Thank you.
Thanks,
So much.
everybody.